Without further ado, let's kick off the webinar with a brief intro to your team behind Doors, Deals, Dollars, also known as your flight crew for this evening. So let's start off with yours truly. My name is Tiffany again, like I mentioned. I am the Director of Syndication at Freeman Lunt and one of your co-pilots for this flight to financial freedom. I spent nearly 2 decades in commercial banking and lending, mastering the art of risk mitigation, underwriting, and strategic deal structuring. I've seen all the ways people have tried and failed to build wealth, and I know firsthand that working smarter, not harder, is the key. Growing up in an immigrant family, I witnessed how financial illiteracy keeps people stuck, so I've made it my mission to change that, not just for myself, but for others too. Today, I'm a wife, a blended family of 6 kids, because, hey, trying to hedge my bet that 1 out of the 6 takes care of me in retirement. Spencer actually is on here, so I'm counting on you, boy. When I'm not turning apartment buildings into wealth building machines, I'm playing board games with my kids, gaming with my husband, or solving puzzles in escape rooms. So enough about me. Let's hear about my co-pilot, Anthony Belcher. Take it away.
Hello, everyone, and I'm Anthony Belcher. I'm excited to have you all here. I have over 30 years of experience in leadership and business management, operations, and real estate, and including 10 years as a business owner myself. I've learned how to turn strategic investments into lasting financial freedom. My focus is applying my analytical and risk mitigating skills that I've honed in the business world to identify strong investment opportunities and build a stable, long-term community in the apartment industry. But beyond business, I'm a Harley enthusiast. You can usually find me on the open roads, searching for that next breath of wind therapy. I'm also on a mission to visit all 30 Major League Baseball parks. I've got 10 down so far, so I still have 20 to go. So now I'm going to switch gears and introduce my partner, Carla Cordovez, who brings her own wealth of experience and insights to the table. Carla, take it away.
Nice. Hi, everyone. My name is Carla Cordovez. I am the managing member of Global Capital. I have over 16 years of experience in customer relations and executive strategy. I'm a real estate investor, business owner who focuses on strong investor connections and successful acquisitions. I speak Spanish, Portuguese, and some Italian. Might speak French as well if I have a croissant next to me. And all of these languages have enhanced my work in account and asset management. I have successful experience in short-term rentals and other businesses, and outside of real estate, you can find me playing pickleball, capturing nature through photography, and enjoying my love for Harry Potter and Wonder Woman. As a team, we have over 20 years in lending, vast experience in residential and commercial real estate, mergers and acquisitions, and providing excellent customer service. Welcome aboard.
Perfect. Well, thank you, Carla and Anthony. All right, let's get an idea of what our audience level of real estate investing experience at this point. We're going to take a quick poll. Are you currently investing in real estate? Are you familiar with multifamily syndication? So I'm going to go ahead and pop that poll real quick here and take a moment to answer that, and we'll move on to the next topic right after.
I'll put the song. Dun, 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 dun.
All right. Ooh, we have a mixed bag of passengers on this flight. Some of you are already in the game and others are just boarding. Perfect. Well, the good news is no matter where you are, we're about to show you how multifamily syndication can be your express lane to wealth. Awesome. All right, I'm going to give a couple more seconds for the last 4 other people who has not participated.
Going once.
Going twice. It's not a pop quiz, guys. All right, well, I'm going to go ahead and end the poll now and share the results. Wow. More than half of you guys are not actually, yeah, there's quite a mixed bag of folks that have not done any real estate investing or they want to learn more. So, all right, Anthony, let's taxi down the runway and dive into what multifamily syndication is and how it works.
Awesome. Thank you, Tiffany. So basically, what is multifamily syndication? Think of it as a first-class upgrade in your real estate investing experience. In a nutshell, multifamily investing allows a bunch of investors to pool their money together to buy a larger property that they typically couldn't afford on their own. So let's dig into a typical cycle for a multifamily investment. The first thing you need to do is you need to find the right property. Our management team identifies an apartment building that fits a specific criteria, which fits into our buy box. It has specific returns, specific class, and in a specific market. Secondly, you get your investors to contribute your funds, pooling your funds together to acquire the property. Then our team handles day-to-day operations to manage and stabilize the complex, making improvements and increasing property value and cash flow. After that happens, you have quarterly distributions. Investors will receive their passive income through quarterly cash flow distributions as a property performs well. And then the final strategy is selling and exiting the property. Typically, this is a three to 7 year program. You sell the property at an appreciated value and you distribute profits to your investors. Simple, strategic, and profitable. So, how will you get there? Achieving financial freedom is like planning a journey across country. How you get there depends on the path that you choose. Some people take a car, or I'm sorry, some people walk with their W-2 job. And if they're lucky, they get a 401k with a matching contribution. Obviously, that's slow, exhausting, and can leave you vulnerable to economic turbulence. The second option is you drive. This usually involves somebody investing into a single family home as a rental or doing fix and flips made popular by HGTV and Chip and Joanna Gaines. That way is also faster, but it requires active management, lots of decision makings, and a lot of time behind the wheel. I'm sure the quickest way that you can see to get to your destination efficiently is by flying. That's what multi-syndication is. You have a team of experts that manage a property for you, handle all the logistics while you sit back, relax, and enjoy your flight to financial freedom. So multifamily syndication is actually your first class ticket to financial independence, excuse me. So the question is, how would you like to travel? Let us know in the chat which way you would like to travel, either by walking, by car, or by plane. All right. Looks like all of you guys want to go by plane. That's awesome. Thank you guys. So when it comes to real estate investing, you have two primary routes. You can take the single family investing route, or you can go multifamily investing. Both can build wealth, but one is a lot slower trip than the other one. And the other one is definitely your first class flight to freedom. So let's break it down. When you have a single family residence, you have one property, you have one renter, and one source of income. You're also the only person there to handle all those maintenance calls. But it is a familiar and simple step because a lot of people already own a home. So it seems like the natural next step. But it is hard to scale. Buying and managing multiple properties comes with their own problems. You have to deal with multiple loans, you have to deal with taxes, you have to deal with insurance policies, and you have those maintenance requests that always seem to interrupt your sleep or your vacation. You essentially bought yourself another job as a landlord. Who wants to do that? Multifamily properties are a fast track to that. You have economies of scale that provide higher returns, making them preferred choice for serious investors. More doors equals more cash flow. Imagine having a 50-unit apartment building with 50 people paying those rents every month. That's 50 income streams, making vacancies far less impactful. But you only have one loan, one tax bill, one roof, and all these expenses are also covered by your tenants. You get professional property management, so your team handles everything for you. No more late night phone calls, no more interrupting your vacation. Plus, you have the stronger appreciation potential. Larger properties are are appreciated based on their income performance, not by market speculation. And the biggest one is you have tax benefits and you have depreciation. Bigger deductions, cost segregation, and more ways to keep your money working for you instead of paying it to Uncle Sam. So imagine, would you like to try to retire off of 10 rental homes, each with its own mortgage, their own tenant issues, maintenance headaches, or compare that to owning one 50-unit complex where professional management does all the heavy lifting and you get to collect all that passive income? Multifamily investing is the difference between being a landlord or being an investor. As we saw earlier, most of you already want to fly. So let's continue to the next slide and see who the key players are in multifamily syndication. So you have two teams. You have the general partner team. They're like the pilots. They do all the heavy lifting. They have to source and acquire the property. They have to create the business plan, secure the financing, perform due diligence, oversee property management, communicate with investors, execute the exit strategy, and all of this, the GP team after all of this work, the GP team only gets 30% of the equity in a typical situation. The limited partners are the first class passengers on the plane. They contribute their capital to the deal. They get to enjoy passive cash flow, tax benefits, equity appreciation, and most of all, no landlord headaches. And they typically receive about 70% of the equity, making them the majority owners of the asset without lifting a finger in daily operations. Obviously, the equity splits can be different depending on the deal, but this is a typical situation. So why does this model work? It allows investors to own a piece of a larger, more profitable asset without needing prior real estate experience. And you get all the benefits of owning real estate while the GP team ensures that the property performs at its best. So the real question is, are you ready to sit back, relax, enjoy your drink, and get on that ride to financial freedom? Okay. So now let's talk about the two different types of investors that are invested in properties. You have an accredited investor and a non-accredited investor. The SEC determines an accredited investor as being someone that makes at least $200,000 a year or $300,000 as a couple, or they have a net worth of $1 million excluding their primary residence, or they can have professional experience, meaning they're a licensed real estate broker or a licensed broker or an executive or a director on a stock issued company. A non-accredited investor doesn't meet the specific criteria, but they do have to have knowledge enough to evaluate the business risks involved in the investment. So now that we're done explaining that, we're going to turn the tables back over to Tiffany to continue your in-flight entertainment. So Tiffany, take it away.
Perfect. Thank you, Anthony, for that great breakdown of the multifamily syndication and how it all works. Hopefully now you have some basic understanding of this. So let's fasten your seatbelts because it's time for some eye-opening truths. Did you know that more millionaires are made through real estate than any other industries? As a matter of fact, 90% of the world's millionaires have built their wealth through real estate investments. And furthermore, the wealthiest 1% of Americans own nearly 70% of all rental real estate in the US. Okay. But here's the kicker. Most of them didn't start out wealthy. They leveraged real estate syndication, AKA other people's money, right, to build passive income and generational wealth. Even Warren Buffett, one of the biggest, greatest investors of all time, bought his first investment property at 14 years old using savings from his paper route. That just comes to show you that it's never too early to start real estate investing. So now that's all fun and exciting, right? But let's move on to the real harsh reality. Ever wondered why the rich seem to keep soaring higher while so many of us are still stuck on the runway? The answer is simple. It's financial illiteracy, right? It's a lack of education in the financial realm. It's not about how much money you make, it's about how much you know. Wealthy individuals understand how to make money work for them while others are stuck trading time for dollars. And without financial education, people unknowingly set themselves up for bumpy landing when it comes to building and keeping wealth. Don't believe me? Well, most people think they're on track for retirement, but the reality, well, let's just say the numbers tell a much different story. Let's take a look at some eye-opening numbers that highlight why financial literacy is smart and smart investing are more important than ever. There are 43% of Americans that actually failed to the financial literacy survey that covers a very basic understanding of financial concepts. That means they are not understanding the fundamental money management principles like interest rates, inflation, and risk diversification. Furthermore, 29% of Americans have some savings, but not enough to cover just 3 months worth of expenses. This highlights the vulnerability that many of us face when we have unexpected financial challenges, right? But here's the big one. 59% of Americans in 2025, according to bankrate.com, wouldn't be able to cover even a $1,000 emergency expense without having to borrow that money. That means over half the country, they would run into trouble if there's just one car repair, one medical bill, or even just a home issue away from actually having financial hardship. That's the reality. These numbers paint a clear picture why financial literacy and strategic investing isn't just optional, it's essential. And that's why you're here today, because you're trying to learn a little bit more about that, right? But this leads me to the next topic, rich dad, poor dad. Quick show of hands, or better yet, drop a yes or no in the chat that how many of you have actually read this book before by Robert Kiyosaki? Yes, Tyler, of course you did. Carla, yep, of course. Anthony, Brock. Yes, if you haven't, you got to read it because you know what? But I got you because no worries. I'm about to give you the in-flight summary of why this book is such a total game changer. Rich Dad, Poor Dad, in a nutshell, really gives us key financial lessons by comparing two very different mindsets, okay? And ultimately, two different destinations in life. The poor dad mindset is where they focus on the job security, saving money, and avoiding risk. And that resonates with me because coming from a family of immigrants, my parents were caught in that rat race of being in the poor realm, right? They're just survival mode. Whereas the rich dad, it's more of an emphasis in financial education, investing, and making money work for you. So really the key takeaways from this book is that financial education is everything. We all know that schools don't teach us how money works. So it's up to us to learn. And that's exactly what we're doing here today, right? We're wanting to escape the rat race. Instead of working for money your whole life, invest strategically so money starts working for you. The idea is to work to learn, not just to earn. Building skills in sales, investing, and negotiation will take you further than just collecting a paycheck. Bottom line, Rich Dad, Poor Dad isn't just a book, it's a wake-up call. It challenges us to think differently about money, break free from outdated financial habits, and take control of our financial future. So if you haven't yet read this book, I would highly recommend it. With that being said, let's move into our next quick pull time, okay? Oops, I'm sorry. Let me go. There you go. How confident are you in your current retirement plan? Take a moment to select your response in the poll. We want to get a sense of how prepared our passengers, aka you, how you feel about your retirement. Your input will help us tailor the flight. So I'm going to pull this up real quick. Give you guys about a minute. All right, looks like we have a really good mix in the cabin today. If you're feeling confident, great. Stick with us because we might show you even a smoother route to financial freedom. Most of you actually said it's somewhat confident. No, that's great. And some of you are not confident at all. So I'm going to share the results for you guys real quick. Look at this, just the group of us right here. There's a vast majority of us that are not very comfortable or 100% comfortable. And so this is exactly why it's all the more important for us to share with you guys some alternative ways to be able to get comfortable. All right, I'm going to stop sharing this and brace yourself, because you know what? You're not alone. If you're not confident in your retirement, a lot of people aren't. As a matter of fact, 80% of older adults actually are at risk of economic insecurity in retirement. Kiss your Social Security, pension goodbye, right? That means most people, despite working hard their entire lives, are not financially prepared to retire comfortably and, more importantly, to stay retired. So, because the reason why is inflation, it keeps eating away at our savings, right? What, eggs are now what, $8, $10 for a dozen? That's ridiculous. And it's just going to keep on climbing. Healthcare costs are also skyrocketing. People are living longer, which means more years of expenses to cover. So what feels like a solid nest egg today, it might not stretch as far as you think. And the last thing you want is to hit retirement and realize your finances aren't cleared for landing. Or, you don't have enough kids like me to make sure you hedge your retirement. So now we're going to bring in Carla to bring down the hard financial truth, how much you actually need to retire and why traditional retirement plans may not just cut it. All right, Carla, you're up.
All right, so that was a very harsh reality just now, of knowing that 80% of older adults maybe can't put away savings. And let's face another reality. How will $100,000, for example, get us there? $100,000 sounds like a lot of money, right? The median household income here in Florida is a little bit over $69,000, according to a study done this year by Smart Asset. But honestly, what will $100,000 actually buy you in 20 or 30 years? Inflation is a silent destroyer of our wealth. It constantly chips away at your purchasing power. Imagine your retirement goals, that dream vacation, comfortable lifestyle, or leaving a legacy for your family. Inflation means those goals become significantly harder to reach with the same amount of money. I recently read a research made by the Johns Hopkins Institute in 2024, and it mentioned that the current life expectancy here in the US is almost of 79 years old. We're fortunate to be living longer than ever before, but this also means that we need our savings to last longer. A traditional retirement timeline may no longer be sufficient to sustain you for this increased life expectancy. I would like to ask you right now, how many of you expect to live past 80 or want to live past 80? Drop me in the chat if you do. All right. I think almost every single person here wants to be not, yeah, Tiffany, not your husband. Sorry, Scott. On the beach, yes, me too. Awesome. Yeah, with good health, right? We want to reach past 80 with good health, with the people that we like to have around us, and with money, with a good sound retirement. And let me tell you a little story. If you're anything like my dad, every single birthday he wishes for another 20 additional years. He started this when he was 50 years old, and now he's 75, and he's still wishing for another 20 years. Every single time. And his desire to live longer every year is a wonderful thing, but it also places greater burden on that retirement planning. You see it and you read it on the news all the time. More and more elderly people are coming back to the workforce because their retirement isn't enough to sustain current costs. And when we talk about healthcare, that's a whole other topic. It's a major and often unpredictable expense, especially as we age. A single unexpected health event can wipe out a significant portion of your savings. And then what? You start from zero again? You can't budget every single medical emergency. This is why you need a financial strategy that can withstand those unforeseen circumstances. The last thing you want is to worry about affording necessary healthcare when you should just enjoy your retirement. Now, let's deep dive in an example right now. Let's take into account $100,000 here in my state, the Sunshine State, Florida. Many people believe that $100,000 is a substantial retirement nest egg. And these numbers that we're looking at here right now, we're talking about real life, real expenses. Here we have the average monthly costs for a two-person household here in Florida, living well within their means. Now, I want you to pay close attention to this. Housing alone, that's at least $1,900 a month. And if you live in Miami or Tampa, for example, that might be much, much more. I've seen the numbers. Transportation, food, tolls, utilities, insurance, you name it. It all adds up. And remember, this is what we're looking right now. This is not a luxurious lifestyle. When you tally everything up, this couple is looking at nearly $72,000 a year. And again, it's just two without children. This is being conservative. All of these numbers are being conservative in many sections. It's a significant chunk of change. So now let's think about those $100,000 that we've talked about so far. How long do you think that that's going to last with expenses like these? With increasing expenses like these, right? Not very long. And here's the kicker. These are today's costs. Inflation is going to continue to push those numbers even higher. In 10 years' time, 20 years' time, all of these numbers will be much, much higher. So what's the solution? How do we make sure that our money keeps up with these economic changes? And that's where multifamily syndication comes in. It's not just about investing. It's about creating a sustainable income stream. It's about having expenses covered by the cash flow from your real estate investments. Instead of watching your savings decrease due to different market turbulence, you're building a reliable source of income. These numbers aren't meant to scare you. They're meant to show you the reality. They highlight the urgency of having a solid financial plan. And they demonstrate that multifamily syndication isn't just a good idea. It's potentially one of the vital tools that we have for securing a financial future. So we've talked about what multifamily syndication is. We've seen a breakdown of $100,000 that can be easily spent on day-to-day expenses throughout that year. Now let's talk about some of the benefits, what it can do for you. And forget the fancy terms for a second, and let's get real about what matters. Building a life where you don't have to trade hours for dollars. Imagine getting paid, even while you're doing anything else. That's passive income. In multifamily syndication, you're an owner, not a landlord. You get the cash flow without the late night tenant calls that Anthony was mentioning earlier. So you want to keep more of what you earn. Real estate is like that secret weapon for taxes, is what Tiffany was alluding to at the beginning about the rich and the millionaire using real estate as a vehicle for their wealth creation. Think of real estate as finding an extra money in your pocket, this cash flow, finding extra money in your pocket, thanks to smart strategies that lower what you're going to owe. And don't put all of your eggs in one basket, just stocks or just bonds, those are all great. But what happens when the market dips? People will always need to rent. And with a growing population, we will need even more housing. Real estate gives you a solid backup plan, something tangible that weathers the storms. And multifamily helps you stay ahead. As rents and property values climb, so does your wealth. It's like having that, your own personal inflation shield. And here's the best part. You're building real, lasting wealth. We're talking about owning something that grows in value over time and securing and helping you secure your financial future and the future of your family. Multifamily syndication isn't just about investing. It's about building a better, more secure life. It's about taking control of your financial future, one smart investment at a time. Now, before we dive in, I'm going to put this big disclaimer. I'm not a tax advisor. None of us are. Please always talk to your financial advisor or any other professional before making financial decisions. So now, having said that, let's talk about something powerful, the tax advantages of real estate. Think of it this way. You want to get to your financial goals faster, right? And you want to reach that destination that is your financial freedom. You could walk, you could take a car, like we've said, but what about taking a plane? That's what we've been talking about all along. That's what real estate tax advantages are all about. They're your financial airplane. One of the biggest benefits of investing in real estate is accelerated depreciation. Every year, your property ages naturally. And with accelerated depreciation, you get to write off that wear and tear, if you will, reducing your taxable income. It's like the wind pushing you forward, making your journey a little bit faster. Let's talk about cost aggregation. This takes depreciation to the next level. We're talking about accelerating the write-offs on specific parts of the properties. It's like hitting the afterburners of the plane and give you that extra burst of speed. And the 1031 exchange is like, let's say, refueling, getting a refueling stop midair. You sell a property, and instead of losing a ton of capital gains on that sale, you can reinvest in another similar property through the 1031 exchange. It's like refueling without landing, keeping you on course and avoiding a major financial setback. And there's more. There's mortgage interest, repairs, insurance. These are like the consistent fuel keeping your plane flying. They're deductions that lower your overall tax bill, keeping your journey smooth and efficient. And taxes are a reality, but with real estate, you're not just passively accepting them. You're actively using them to your advantage. You're using the tax code to accelerate your wealth building. You're using that airplane to get to your financial goals faster than you ever thought possible. So, are you ready to board?
Heck yeah. I was on mute earlier. All right, well, thank you, Carla. To summarize, this chart breaks down how multifamily syndication stacks up against other investment vehicles. Again, I can't stress enough, though, guys, that multifamily syndication is just another tool under your belt on how to scale wealth, right? This is not the only way, but this is definitely another way. Now, let's just briefly go through this real quick. Compared to stocks, it's often, it offers potential passive income and tax benefits, right? That when you have stocks and bonds, there's a lot of volatility to that, versus here, it's a lot more conservative approach. And on top of that, you get that was Carla had mentioned, the cost aggregation and bonus appreciation that stocks and bonds don't offer you. Okay. The other thing, as Anthony had mentioned previously, the comparison between single family rentals versus multifamily. It really goes down to the design of scalability and professional management, reducing the hands-on burden, right? And you don't have to be that landlord. But remember, I would be remiss if I don't say this, all investments carry risks and returns are never guaranteed. That's why it's crucial to consult with your financial or tax professionals to ensure that this aligns with your goals, okay? All right. This is the mindset shift that changes everything. Don't say, I can't afford it. Instead, ask, how can I afford it? And Robert Kiyosaki said that best, right? And so when you say, I can't afford it, this shuts down the possibilities. It reinforces the limitations and stops you from looking for solutions. Whereas if you were to say, how can I afford it? This opens the door to creativity, problem solving, and financial growth. It shifts your mindset from scarcity to opportunity. And successful investors think differently. Instead of saying, I don't have enough money to invest, they ask, how can I find the capital? Or I don't have experience becomes, how can I leverage the expertise of others? So that leads us to the next question. All right, just a quick follow-up question to our previous poll about your confidence level in your retirement plan. Let's take a moment to submit your responses in the poll to give us an idea. What did you do with your 401k when you left your previous job, right? All right, so I'm going to pop this up real quick. Awesome. A lot of you guys voted
Scott
over.
said that he used it in Vegas.
Vegas? Okay, Scott. Perfect. All right.
Nice, Mike.
Yeah, some of you guys, I don't know, man. You guys act like you're like taking a quiz. All right, I'm gonna move on here. It looks like there's a great, it's good to see that like over 70% of you guys actually, oops, yep, you see the results there? Over 70% of you guys actually rolled it over. But what happens if you don't? If you left, some people, there's actually a lot of people who actually forget about it too, right? They forget that if they leave it dormant, it's not really doing anything for you. It's not earning as much interest. And so, and some of you actually had to cash out. So yeah, that's interesting. Well, that's great and all. I guess the relevant question would be, great, Tiffany, multifamily investing sounds great, but not every one of us have the funds to set aside for something like this, right? Remember, it's all in the mindset shift. It's not, I don't have enough money to invest, but rather, how can I find the capital? So Carla, I'm gonna tee you up here where you can help us find out ways to do so.
Absolutely. So how can we afford this then? What can we do if we don't have big savings? And these are just some options. There are various out there. But we've talked about the plane, we've talked about the destination, and just a little about the fuel. What if you could supercharge your journey to financial freedom, or some of the ways that you can do that? That's where self-directed IRAs, SDIRA for short, and 401ks come in. Let's think of it this way. You have this incredible airplane, multifamily syndication, and you're ready to take it to your financial goals, but you need the fuel to get you moving. This comes directly from the SEC.gov website. A self-directed IRA account permits investments in alternative assets other than publicly traded stocks and bonds, such as promissory notes, real estate, private placement securities, and precious metals. Many people choose traditional and Roth IRAs over a self-directed IRA, many times because they don't know that there are other options. No one told them that they may be missing out on investment opportunities in other sectors. A self-directed IRA, for example, opens up those possibilities. Instead of being limited to stocks and bonds, an SDIRA lets you invest in real estate, including multifamily syndications, without needing to come up with extra cash out of nowhere. Imagine using your retirement funds to directly invest in deals that generate cash flow and appreciation, all while being tax advantaged. It's like filling your plane with the most efficient fuel available, allowing you to reach your desired altitude and reaching your destination much, much faster. And if you have a 401k, consider it your reserve fuel tank. You might be able to roll over a portion of your 401k into an SDIRA, for example, giving you even more firepower for your real estate investments. I also want to remind you why you may want to use that capital you already have in your SDIRA, for example, because it's already sitting there. You know, it's not working for you. If you withdraw capital from your retirement account, it often comes with penalties and fees, which decrease your purchasing power. Through real estate investments, in this case, multifamily syndication, you're able to use that capital and make it work for you to acquire even more capital without needing to pay any penalties associated with regular withdrawal. So with all this info, I ask, what mode of transportation will you choose towards achieving your financial freedom? Do you want to walk? Do you want to drive? Or do you want to fly? Put it in the chat. Let's see. I think most of you said
Believe
fly
I
at the
can
beginning.
fly, guys, yeah. Come on, I want to see more people.
Nice,
Private jets,
Gary.
Dion. Love
Dion
it.
is ready to get into that supersonic one.
Rock G5. All
Awesome.
right. So as we have previously mentioned, right, financial freedom is a journey, guys. So whether you're walking, driving, or flying, or that in another case, relying on your W-2, or doing your fix and flips, or, in this case, multifamily investing, there's different modes of transportation. So if you're ready to accelerate your path and explore new opportunities, let's connect. Reach out to us. And we're happy to answer any of your questions, right? We're gonna go ahead and move into the Q&A. All right. So I'm seeing here, you guys can raise your hand or you can throw it in the chat. I know that was a lot of information to digest. It is a very vast topic, and to condense it down in less than 45 minutes, it's very difficult. So it's a lot of, broad topics here, but if you have any